Yeah, day 15, we'll continue with equity securities. So my exam went really well, might even get full, so that's good. And yeah, let's continue. Where were we? Actually, don't remember. I think we were here maybe. We're done concept check 2.5. Okay. Okay, I think we were here. So yeah, let's begin. Actually, most indexes today use a modified version of the market value weights. Rather than weighting by total market value, they weight by the market value of free float. That is, by the value of shares that are freely tradable among investors. For example, this procedure does not count shares held by founding families or governments. These are shares are effectively not available for investors to purchase. The distinction is more important in Japan and Europe, where higher fractions of shares are held in such non-traded portfolios. A nice feature of both market value weighted and price weighted indexes is that they reflect the returns to straightforward portfolio strategies. Nice feature of both market value weighted and price weighted indexes is that they reflect the returns to straightforward portfolio strategies. If one were to buy shares in each component firm in the index in proportion to its outstanding market value, the value weighted index would perfectly track capital gains on the underlying portfolios. Similarly, a price weighted index tracks the returns on a portfolio comprised of an equal number of shares of each firm. Investors today can easily buy market indexes for their portfolios. One way is to purchase shares in mutual funds that hold shares in proportion to their representation in the S&P 500 or another index. These index funds yield a return equal to that of the index and so provide a low-cost passive investment strategy. Another approach is to purchase an exchange traded fund or ETF, which is a portfolio of shares that can be bought or sold as a unit. Just as one can buy or sell a single share of stock. Available ETFs range from portfolios that track extremely broad global market indexes all the way to narrow industry indexes. We discussed both mutual funds and ETFs in detail in Chapter 4. Other US market value indexes. The NYSE publishes a market value weighted composite of all NYSE listed stocks, in addition to sub indexes for industrial, utility, transportation, and financial stocks. These indexes are even more broadly based than the S&P 500. Nasdaq computes a composite index of more than 3,000 firms traded on the Nasdaq market. The Nasdaq 100 is a subset of the larger firms in the composite index, but it accounts for a large fraction of its total market capitalization. The ultimate US equity index so far is the Wilshire 5000 index of the market value of essentially all actively traded stocks in the US. At one point, it included more than 5,000 stocks, but today there are fewer than 4,000 stocks in the index. A similar comprehensive index is published by the CRSP, the Center for Research and Security Prices at University of Chicago. Equally weighted indexes. Market performances Market performance is sometimes measured by an equally weighted average of the returns of each stock in an index. Such an averaging technique by placing equal weight on each return corresponds to an implicit portfolio strategy that invests equal dollar values in each stock. This is in contrast to both price weighting, which requires equal numbers of shares of each stock, and market value weighting, which requires investments in proportion to outstanding value. Unlike price or market value weighted indexes, equally weighted indexes do not correspond to buy and hold portfolio strategies. Suppose that you start with equal dollar investments in the two stocks of table 2.3, ABC and XYZ. Because ABC increases in value by 20% over the year, while XYZ decreases by 10%, your portfolio no longer is equally weighted. It is now more heavily invested in ABC. To reset the portfolio to equal weights, you would need to rebalance, sell off some ABC stock and or purchase more XYZ stock. Such rebalance, such rebalancing would be necessary to align the return on your portfolio with that on equally weighted index. Foreign and international stock market indexes. Development in financial markets worldwide includes the construction of indexes for these markets. Among these are the Nikkei, Japan, FTSE, UK, pronounced FTSE, DAX, Germany, Hang Seng, Hong Kong, and TSX, Canada. A leader in the construction of international indexes has been MSCI, Morgan Stanley Capital International, which computes dozens of country indexes and several regional indexes. Table 2.6 presents many of the indexes computed by MSCI. Bond market indicators. Just as stock market indexes provide guidance concerning the performance of the overall stock market, several bond market indicators measure the performance of various categories of bonds. The three most well-known indexes are those of Merrill Lynch, Barclays, and Citi Broad Investment Grade Bond Index. Figure 2.9 shows the components of US fixed income market in 2016. The major problem with the bond market indexes is that the true rates of return on many bonds are difficult to compute because the infrequency with which bonds trade makes reliable up-to-date prices difficult to obtain. In practice, some prices must be estimated from bond valuation models. These matrix prices may differ from the true market values. So that was equity markets. We're done with that. Now we will start with 2.5 derivative markets. So let's begin. Futures, options, and related derivative contracts provide payoffs that depend on the value of other variables such as commodity prices, bond and stock prices, interest rates, or market index values. For this reason, these instruments sometimes are called derivative assets. Their values derive from the values of other assets. These assets are also called contingent claims because their payoffs are contingent on the value of other values. Options. A call option gives its holder the right to purchase an asset for a specified price called the exercise or strike price on or before the specified expiration date. For example, a July call option on the IBM stock with an exercise price of $150 entitles its owner to buy IBM stock for price of $150 at any time up to and including the expiration date in July. Each option contract is for the purchase of 100 shares. However, quotations are made on a per share basis. The holder of the call need not exercise the option. It would be profitable to exercise only if the market value of the asset may be purchased exceeds the exercise price. When the market price exceeds the exercise price, the option holder may call away the asset for the exercise price and reap a payoff equal to the difference between the stock price and the exercise price. Otherwise, the option will be left under exercised. If not exercised before the expiration date, of the contract, the option simply expires and no longer has value. Calls therefore provide greater profits when stock prices increase and thus represent bullish investment vehicles. In contrast, a put option gives its holder the rights to sell an asset for a specified exercise price on or before a specified expiration date. A July put on IBM with an exercise price of $150 thus entitles its owner to sell IBM stock to put writer at a price of $150 at any time before the expiration in July, even if the market price of IBM is lower than $150. Whereas profits on call options increase when the asset increases in value. Profits on put options increase when the asset falls in value. The put is exercised only if its holder can deliver an asset worth less than the exercise price in return for the exercise price. Let me read that again, actually, I don't understand. In contrast, a put option gives its holder the right to sell an asset for a specified exercise price on or before a specified expiration date. A July put on IBM with expiration of $150 thus entitles its owner to sell IBM stock to put uh, the, to the put writer at a price of $150 at any time before expiration in July, even if the market price of IBM is lower than $150. Even if the market price of IBM is lower. Okay. Whereas profits on call options increase when the asset increases in value, profits on put options increase when the asset value falls. Sell an asset. Okay. But put is exercised only if its holder can deliver an asset worth less than the exercise price in return for the exercise price. Table 2.7. Hmm. Okay. Table 2.7 presents prices of IBM options on May 10th, 2016. The price of IBM shares on this day was $149.97. The first two columns give the expiration month and exercise or strike price for each option. We have included the listings for call and put options with exercise prices of $145, $150 and $155 per share, and with the expiration dates in June and July 2016. For example, the July 2016 expiration call with an exercise price of $150 last traded at $4.43, meaning that an option to purchase one share of IBM at an exercise price of 150 sold for 4.43. Each option contract on 100 shares therefore costs $443. Notice that the prices of call options decrease as the exercise price increases. For example, the July expiration call with exercise price 155 only cost only 2.28. This makes sense because the right to purchase a share at a higher price is less valuable. Conversely, put prices increase with the exercise price. The right to sell IBM at a price of $150 in July cost $4.42, while the right to sell at 155 costs $7.30. Option prices also increase with time until expiration. Clearly, no one would rather have the right to buy an IBM for $150 and at any time until July, rather than wait rather than at any time until June. Not surprisingly, this shows up in a higher price for longer expiration options. For example, the call with exercise price $150 expiring in July sells for $4.43 compared to only $3.31 for the June call. Yeah, sorry. Concept check 2.6. What would be the profit or loss per share to an investor who bought the June 2016 expiration IBM call option with exercise price $150 if the stock price at expiration date is $157? What would be the profit? So he can buy 150, so the profit would be $7 because he can instantly buy it at 150 and then sell it at 157, so he can make a quick $7. And 50 minus 157 minus 150, I'll just put this in bracket, times actually 100 because they said 100 shares, so it'll be like $700 will be the profit. Pretty neat. What about a purchaser of the put option with the same exact price and expiration? So the put option guy, I don't think he has to sell it. Yeah, he doesn't have to realize the loss. I mean, if he sold it, he would make a loss of a 700, obviously. But like, you know, wait 1 second actually. No, to sell. Oh yeah, sell for $150. Yeah, okay. He would also make a loss of 700 only. So let's just quickly see the answer for this one if it's correct. Follow through. Solution concept checks. So as we can see, the payoff for call option 7 per share. Call option what? 3.31. Yeah, $7 per share at expiration. The option cost is 3.31 per share. Dollar profit is about $3.69. I don't understand. I mean, 3.3, $3.3. That doesn't make a lot of sense. Let me ask. Let me ask ChatGPT, because that answer really doesn't really make any sense. It's either that or I'm like way too sleepy right now, so I have to check. Yeah, again, I mean, I'm only getting the $7, and so is ChatGPT. So I really don't know what this 3.30 business is about. The option cost is $3.31 per share. Who said that? Oh, we have to refer to the table. They've given us some values here. That's crazy. I don't know that, you know. But yeah, okay, fair enough. Excess price. Okay. What does that mean though? Have they explained table 2.7 anywhere? Okay, here it is. I see Ivan shares first accounts give an expiration monthly exercise. Listings for call and put options with exercise prices of per share. Okay, this is like per share. Okay, fair enough, fair enough. I mean, so if it's per share, what? Okay, 1 second. Oh, so the option contract costs that much. Okay. June 2016. Uh, which one? Like, there are 3 Junes over here. Which one are you talking about? 3.31 per share. I think it's talking about the second one, I guess, then. Okay, so basically what you're getting is, so this is whatever, it's fine. But actually the profit per share is equal to $7 minus 3.31, which is $3.69. This is per share, which makes sense. And then for the put, option expires worthless, so like 0. So investors loss is the cost of the put. Also, you have to like pay money for the cost and put as well. Actually, that makes sense. So For the put, loss from put equals to 0 minus the put was 3.30, therefore the loss would be $3.30 would be the loss. We're done with that. Now let's move on to futures contracts. We have about I don't know 18 minutes left or so. Yeah, future contracts calls for delivery of an asset, or in some cases its cash value, at a specified delivery or maturity date for an agreed upon price called the futures price, to be paid upon at contract maturity. The long position is held by the trader who commits to purchasing the asset on the delivery date. The trader who takes the short position commits to delivering the asset at contract maturity. Delivery of an asset specified. Okay. Futures price, long position held by the trader commits to purchasing the asset on the delivery date. Trader who takes out short position commits to delivering the asset on contract maturity. Table 2.8 presents corn futures contracts on the Chicago Mercantile Exchange on May 10, 2016. Each contract calls for delivery of 5,000 bushels of corn. The first entry is for the newest term of front contract. With maturity in July 2016. The futures price for delivery in May was 3.81 per bushel. The trader holding the long position profits from price increases. Suppose that at contract maturity, uh, corn is selling for $3.83 per bushel. The long position trader who entered the contract at the futures price of $3.81 on May 10th would pay the previously agreed upon $3.81 for each bushel of corn, which at contract maturity would be worth $3.83. Because each contract calls for delivery of 5,000 bushels, profit to the long position would equal 5,000 times 3.83 minus 3.81. 1 second. Suppose the contract maturity is selling for 3.83. Okay. So 5,000 is the number of bushels of corn. 3.83 is the current price. 3.81 is the price that was promised. So the trader makes $1,000. Conversely, the short position must deliver 5,000 bushels for the previously agreed upon futures price. Short position's loss equals the long position's profit. The right to purchase the asset at the agreed upon price as opposed to the obligation distinguishes call options from long positions and futures contracts. A future contract obliges the long position to purchase the asset at future price. The call option, in contrast, conveys the right to purchase an asset at the exercise price. The purchase will be made only if it yields a profit. Clearly, a holder of a call has a better position than the holder of a long position or futures contract with futures price is equal to options exercise price. The advantage, of course, comes at a price. Call options must be purchased. Future contracts are entered into without cost. Purchase price of an option is called the premium. It represents the compensation the purchaser of the call must pay for the ability to exercise uh, the option only when it is profitable to do so. Similarly, the difference between a put option and the short futures positions uh, is the right as opposed to the obligation to sell an asset at an agreed upon price. So basically, what we talked about there was basically in futures you like have to buy what you said, so like you have to follow through. But in calling or putting, you don't have to do it. Like you have the choice to do it if the situation is suited to you. But if you think or if you know that the prices are higher than what you are supposed to pay, then you can just not pay. But unfortunately, you can't do that with futures. You have to pay what you promised, and you have to also buy what you promised. So it's a two-way street. So anyways, yeah. Now I'll be reading Indian perspective. Sorry, I'm a lot sleepy today actually. So yeah, that's why I've been pausing a lot the whole time. Anyways, Indian perspective is here we briefly present the key features of some of the money market instruments available in India. We then briefly discuss the dated securities and the securitization market in India. Then we briefly show how Sensex is calculated, labeled using free float methodology. We conclude by briefly discussing about a different bond market introduces um, indices that the National Stock Exchange NSE calculates. Actually, I'm done for today because I'm feeling very, very sleepy. And to be honest, I'm not really understanding much of what I'm reading. So I think that was like a little bit over an hour. Not hour, sorry, half an hour. But yeah, decent bit of coverage that we did. We covered the indexes, and most importantly, we covered call, put, and some future contracts. So we'll continue with the Indian perspective tomorrow. But right now, I'm just way too sleepy for this. I have to have some coffee or something. So, anyways, thanks.